I think we've got a great topic, and it's near and dear to all of our hearts. And I think I'll start with the framework for the conversation, which is Siri's pronouncement that, not another dollar should go towards old energy. It ought to go towards new energy. There's an awful lot of money we need to deploy to sort of change our carbon footprint as an economy. And what we have is, I think, some interesting topics to cover relative to how do asset owners think about these things. And I have two asset owners at the far left who have wrestled with these very challenges.
Not to talk about our politics, but anyway.
And then on the right, we have two asset managers who have been thinking about these issues for quite a long time. And nicely in the middle, we have somebody who sort of straddles those things about how do you think about these and implementing various solutions. So I'm going to let each of them introduce themselves in succession. They'll do a better job about doing that, and then I'll provide a little briefing about what we're going to talk about.
Great, I think I'm first.
Please, Rob. Thanks, Rob Day.
So I'm Rob Day. I've been an investor in the sector now for 13 years and counting, 7 years of which I spent fairly recently at a single-family office, really trying to figure out how to find superior risk-adjusted returns. So we did not have an impact mandate, but looking across the sustainable side of energy, food, water, and waste, there was that inherent aspect to it. Along the way, since we were trying to think about entirely new investment models, we formed a collaboration platform which merged with another one, which is now called the CREO Syndicate, largely made up of family offices, but with some other non-traditional investor types around the table as well, really trying to drive new investment models. And also, especially in collaboration with some of those groups, our team at our single-family office, after a lot of experimentation of different models, some of which went well, some of which did not, but we hit upon a strategy that we really like. We saw there are so many distributed type solutions, really smaller scale type solutions in these energy, food, water, and waste spaces that have really compelling economics, are now ready, but just too small for project finance. So now we have formed our team outside of the single-family office setting as Spring Lane Capital to pursue that strategy.
Thanks. Hi, I'm Kareen Laton. I work at a firm called Greentech Capital Advisors. Our firm has sort of two sides to the business. We are an asset manager, but we also started off on the more traditional advisory side of the business. So about 10 years ago, our firm was founded to do traditional M&A advisory, private placement work, all through the sustainable infrastructure space. And about 5 years ago, we got started on the asset management side, initially with our flagship fund, which we'll focus on a bit more, I think, in this conversation today, which is a public equities, long-only vehicle that focuses on environmental sectors, and mostly through the lens of kind of resources, industrial services, and energy, and looking for companies taking a bottom-up fundamental approach and sort of conviction investing approach that are really, we believe, to be the growth compounders over time because they derive a certain percentage of the revenue from what we define as sustainability initiatives and heading to north of 50% of the revenue from sustainability initiatives. So we could talk a little bit more about it in the context of the conversation. And we recently brought on board an emerging and frontier markets fund from another firm that integrates ESG through its criteria. And while that fund contemplates climate and environment, because the countries themselves are some of the most challenged when it comes to climate change, it's a little bit more mapped towards the SDGs, which we just heard about in one of the previous panels, looking for growth drivers, domestic growth drivers across a very diversified universe of countries and companies globally. So that's Greentech, and hopefully we can talk a little bit more about how we think about the world in that lens.
I'm Torsten Marshall. I am in the middle, and I am a lawyer at Orrick, Herrington, and Sutcliffe, and I have been working in the energy space for almost 25 years now. And I was a lawyer a little bit before that, but most of my career has been in the energy space, and the vast majority of that has been doing renewable energy work, including financings of solar projects and wind projects. And most of those are what we call utility scale projects, which are very large projects where the power is sold to utilities who sell it on to end users. And I've also done quite a bit of work with the Overseas Private Investment Corporation worldwide in financing investment funds that are investing in developing countries around the world. We also, as lawyers, all of us do a lot of pro bono work, which is basically work we perform for free, and I know that's against the capital markets, but we try to do that every once in a while. And most of that I try to work within the space I have the most knowledge, which is the energy and environmental field. So I think when I get to talk a little bit later, I'll talk about how my two worlds mesh and how we're using some of the skills and products that we use in the regular capital market space in the impact investing space. So I think that and I've just recently become involved in it, and it's kind of consuming a large portion of my life right now. So I'll talk about that a little bit later, and since I'm the most boring person on the panel, I'll try to keep it as short as possible.
Thanks, Torsten. Joseph?
My name is Joseph Kinard. I represent the Presbyterian Church USA, the Board of Pensions, which I've sat on the investment committee for nearly 10 years. I also recently became the chair of what they call mission responsibility through investment for the pension fund and for the Presbyterian Church USA. It's a small fund of roughly around $10 billion. And we have been at this for a while. We'll talk about this later on, but MRTI, as it's known, was started in 1971, so we're not new to the impact game, so to speak. We have been doing a lot in terms of socially responsible investing, things of that nature for quite some time, but the ESG has taken on a significant role in the last 5 to 6 years, something of that nature.
Thanks. JoAnn?
Good morning, everybody. My name is JoAnn Hanson, and I'm the president of the Church Investment Group, which we call CIG for short. And CIG is a nonprofit which manages Episcopal Church endowments. And we really have two primary missions. One is to enable our endowments to realize the benefits of investing at scale through using an outsourced chief investment officer. We use Hurdle Callahan. And the second, and the topic of today, is encouraging our endowments to adopt ethical investing policies. And if you look at what churches are doing, they spend 4 to 5% on their mission. There's another 95% that's still in there in the endowment. And how can those assets be effectively deployed to also, as the word is, have impact? We, at this point, it's not something that we require of our endowments, but through our educational efforts, all of them have chosen to adopt ESG, environmental social governance. Half of them are approaching it all industries, so they include energy, and half of them have chosen to divest.
Great, thanks for all of you joining us. We're talking about addressing environmental risks and challenges, particularly around climate risk in investment portfolios. And I have the pleasure of representing a firm that's been thinking about these things for the last 20 years or so, thinking about the environmental opportunities that are created by the challenges that we have. And one of the things that we want to talk about is, what are the challenges and what are the opportunities that we're trying to address in thinking differently about our investment portfolios. Rob, you've been in this space a long time too, so maybe you could spend some time talking about the opportunities and challenges.
Sure, and I think they're two sides of the same coin in many cases, right? Because, as I'll mention in a minute, The challenge is being able to be comfortable as an asset allocator, putting money into new models, but that's also where a lot of the opportunity lies. It's also important to take a step back, I think, and just acknowledge, while my focus is really on the private markets side of all of this, that's just where I've spent my career. On the public equity side as well, and increasingly into other asset categories, there's an emerging body of data and study that suggests that applying climate risk screens within an asset category, within a sector, yields good financial results just inherently. A lot of reasons why that might be the case I'll leave to people with more experience on that topic. But on the private market side, you know, I was really struck a couple of months ago when I was at an oil and gas investing conference. And a question was asked of one of the speakers there, you know, with the current prices of oil and blah, 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 you know, where's the right place to be putting money, da, da, da. And the specific answer of what's hot right now wasn't really relevant to me. But what I was really struck by was when he said, look, across the oil and gas investment spectrum, we have such a robust capital ecosystem. We have so many different choices of types of investments, different risks and reward profiles. We've got upstream all the way to downstream. We've got different geographies we can invest in. No matter where we are in any given economic cycle, there's someplace we should be putting our money at that point in time. And I took a step back and I said, that's really what we are missing on our side of it, on the renewable side of it, and especially true then looking beyond just energy into food, water, and waste. There was, you know, some really, I loved this morning's speakers. I learned a lot from them. One of the things that was said that was really striking was, you know, some speakers saying there's plenty of new models out there now that you can choose from, that there's not a scarcity of investment opportunities. I would actually push back on that gently, because I think it matters a lot as to what your threshold is for feeling comfortable with putting capital at work into a new model. And from my perspective, having been an investor in this sector for a long time, I see so many different emerging new models that would really fill in those gaps that we see right now on the renewable side, on the sustainability side, with just looking at an orientation around, you know, market level returns and the like as well. Lots of really strong managers coming out with really compelling approaches that are better suited, for instance, in the energy space than, you know, clean tech venture capital might have been in its original incarnation. The challenge is for a lot of those new models and new managers getting to a point of actually being able to get capital that they can put to work around these new models to establish the kind of track record that would unleash the trillions of dollars that I'm telling you is waiting to be unleashed into this market. All the available evidence suggests that, you know, if we can hand mainstream large capital allocators a black box and you just say, turn this crank and you will make market level, if not better, returns from investing into the sustainability side of things. There are a whole host of multi-trillions of dollars of asset allocators out there who are really eager for that, even if they're not viewing it from an impact lens, but just a 30-year investment horizon lens. We need to get to that point, though, where these models are just that, hey, it's simple, just turn the crank on this thing, it makes money. And getting from here to there, there's a huge challenge, but also a huge opportunity for impact investors to play a catalytic role in helping those new models get off the ground.
Yeah, Kareen, you come at it from the public side versus the private side. What are you seeing in the public side?
Yeah, no, thank you, and thank you for your comments, Rob. From the public side, you know, for us, despite the name of our firm being Greentech, it's really not, you know, green for us is money, right? This is not a compromise of return. What we do in our portfolios is we're looking for companies, and many of them are incumbents, so these are not new business models. These are incumbent companies that are transforming the way they operate their business models for a future that contemplates climate change and that contemplates doing business in a profitable manner because they have to provide goods and services to a world that needs it. I'll give you some examples. Old line companies that some people would put into an industrial bucket, Ingersoll Rand doing a lot of work in the in the HVAC space for LEED certified buildings globally. So we look at the world in our developed equity fund through kind of 8 key subsectors. Some of them are about renewables, but we're value investors at our hearts. And what we do is fundamental bottom-up stock picking, looking for materiality at the company level, integrating the E, the S, and the G, but really looking for growth at a reasonable price. And doing it by putting risk capital at work and concentrating our portfolio. So both our emerging markets and frontier markets fund and our developed equity fund are very concentrated portfolios. We believe in portfolio theory, that you put your risk capital at work and you size appropriately, you are going to get above market return. And that's what we've been proving. So although our firm is younger and these strategies are, kind of at their 3-year mark, our investment teams have been doing this for the bulk of their careers and then have found themselves in the sustainable space, but came at it from the traditional space. So what we're seeing at the company level is, companies in the automotive sector, the theme of advanced mobility. Who are the new entrants? Who are the technology companies that are providing the technology going in and, up through the supply chain of the vehicle? Who are the providers of materials for the new EVs that are making the cars lighter and more efficient? The heating systems that go into the seats, the display screens that go into the car. So that's one theme and one bucket. In the water space, we look at everything from desalination plants to purification systems to the water that you probably all get in your offices in the cooler that's hooked up to the wall, the company that manufactures those standalone models. In the energy efficiency space, we look at the grid, we look at technologies around the grid. So it's very diversified across sectors, but if you actually were to kind of open the hood and look at our portfolio, and I'm speaking more from the developed equity side, these are companies we all know, although some of them are misunderstood by the market, and that's the great opportunity. So if you can do the work and kind of apply a traditional fundamental research approach, for us it's not negative screen, it's really a positive screen. It's not really about divestment, but you won't see us in either of our portfolios buying companies that tend to be emitters, because we also think that that's not where the future is. So we can make a choice, a pretty tough choice about concentrating our risk in what we believe are sort of positive screens, growth in the future, and do it in a diversified manner. EM is a little bit of a different lilt. Here we are, as I mentioned to you earlier, it's a bit more of a theme where the portfolio itself is very focused on growth drivers at the country level. But we see themes across regions, for example, mobile money. Most of you have heard, maybe in the private space, about these mobile money stories where you have huge populations, low GDP per capita in countries and populations that are unbankable. So we have found in the public equity space ways to play that theme. In Kenya, for example, it's a telco solution. Safaricom is a well-known name where it's a mobile money system through the phone. In little Bangladesh, but little meaning 200 million people in Bangladesh, most of whom are unbankable, bKash, which is a subsidiary of a large private bank called Brock Bank, which was sponsored by the Grameen Foundation, some of you may know from the impact world, is one of the largest mobile money systems outside of not WeChat, but the out of Tencent's solution. So just because of the size and breadth and depth of the population, and what's happening is we look at these stories through a global lens, and we can sort of see what's worked really well in one country and where other countries are headed. But it's also about food safety, it's about healthcare, it's about education, it's about democratization. But at the end of the day, it's also about the management teams of these companies. Is there good corporate governance? So in the EM fund, the G is heavily weighted. We do care about the climate because the countries themselves are challenged. So if you're a producer of food and water, for example, or even cement, which I know sounds like a total naysayer. We don't have any in the portfolio today, but we will look at cement because infrastructure is there's so much pent-up infrastructure demand in emerging and frontier markets. You need cement to build roads and bridges. But the key is, how is that cement company running its operations? Are they using coal-fired plants, or are they switching to natural gas? If it's improving, that's okay. We can get comfort. But then we push and we engage with company management teams to tell them, have you thought about doing this better? So engagement is an offshoot of this process. So we're not activists, but we are active owners of our companies, and we feel that we can make a difference, and we collaborate with other managers to do that, because we can represent billions of dollars, or if not trillions of dollars, over time as more people. And EM is early days, right? ESG, it's early days. So we're really excited, and effectively for the asset owner side, we believe that we can provide what they need in their portfolios to meet their criteria for the threshold, whether it's an endowment foundation or pension plan, but not at a compromise of return, and still participating in the growth.
Disruption seems like it's a theme that we'll touch on, disrupting normative thinking and thinking differently. And Torsten, you've been working on disruption and business models and bringing capital to new places, and maybe you can share some of your ideas on the risks and opportunities.
Yeah, sure. It's what's interesting being involved in the renewable energy business over the past 20, 25 years is how it's totally disrupted the energy markets in the United States and the power generation markets in particular. And it's done that in a lot of different ways. And one of the ways is that people demand it. Another one of the ways is that governments have backed it through tax incentives and other means. And also state governments have been very important as well, because they have renewable standards that they are imposing upon the people that are providing energy in their markets. So a lot of these things have driven the markets, and for a while the biggest problem was that they were too expensive. Wind energy was very expensive, solar is very expensive, and lately we're coming to an inflection point where the cost of production has gone down quite a bit. And that's both on the wind side and the solar side, and it's in particular on the solar side is that the cost of making solar panels and all the equipment that are related to it has gone down so much that solar is becoming very competitive, and probably over the next 5 to 10 years it will become cheaper than natural gas and much cheaper than coal, which is why you see a lot of coal plants, we were talking about it earlier today, disappearing. They're being put in mothballs, they're being converted to natural gas plants, et cetera. So it's been really exciting to be a part of that space. And in terms of kind of one of the examples I wanted to give of how what I'm doing is kind of coming out of the energy space and going through the environmental sector is how we finance things. The main way we finance is through project finance, as most of you probably know, but I can kind of briefly describe it for those who don't know it. It's basically a means of providing capital to people who need it. So there's a demand, and the demand is capital that wants to be invested, and there's a need. And in the energy space, it's the need to provide financing to build power plants. And so what you do is you do a quick analysis of is this a financeable project? And the main thing you look at is, who are the beneficiaries of the project? Well, obviously for a power project, it's the people who use the power, buy and use the power. And so then the question is, okay, how are you going to monetize that? Well, the people who buy the power pay money to the utilities, and the utilities will buy the power from us. And so what you do is say, well, how are the utilities buying power from us? We enter into a contract with them, just like we as consumers enter into a contract with our power companies to provide us power, so we have electricity in our homes. So in essence, what we're doing is we have a need to buy a project. We have a contract with the utility that will buy power from that project. So what we're doing is we're monetizing the need. And then you say, well, what do I have to do now? You have to build the project. And that's where investors come in. And there's a combination of debt and equity investments in these projects. So the sponsor will go out and enter into contracts with debt providers and with equity providers to help finance the cost of the project. And the reason that those debt and equity providers come in is because they have contracts that are available that will buy the energy, that will provide the capital to pay off the investors, right? So it's like the return, as we've talked about, is the most important thing. So the investors want to make sure that they can make a reasonable market return on their investments. So doing that in the impact finance space has really not been a model. I mean, most of what I've done in doing pro bono work and otherwise, and I have a wife that's in the nonprofit field, so I live it every day at home, is that the financing in nonprofits and for impact investing have taken a lot of different forms. There's grants, loans, credit enhancement through guarantees, and equity investments. And what we're seeing now, and we've been involved with a company called...
Sorry, Torsten, are these focused on climate risk? Because we're trying to keep on that.
Yes, and this is what I'm getting to.
Great.
The climate part. And so, and that was all as background to kind of talk about what we're doing with a company called Blue Forest Conservation. And what they're interested in is basically cleaning up forests in the western United States, and for a lot of different reasons. And one of the reasons is that cleaning forest and making them more vital is it helps the climate by having more forest, right? So the forests don't die off. It also helps water supplies, because by cleaning the forest, you're cleaning the water that's coursing through the forest, and that water is used by a lot of different people. It's used by wildlife, it's used by utilities that provide power, used by utilities that provide water. So in essence, what Blue Forest Conservation is doing is putting together a product that looks very much like a project finance. So what they're doing is they define a need, which is to clean up the forest, right? And to provide all these environmental benefits along with benefits to other beneficiaries, such as the Forest Service, such as water utilities, such as electric utilities, et cetera. And what they're doing is doing a project, using a project finance model to do that. And we think that this is a type of thing that can be used throughout the climate space, the environmental and climate space. And in essence, what they're doing is creating what they're calling a forestry resilience bond, and going to the people that want a return to say, look, you know, what I'd like you to do is fund the upfront costs of repairing these forests, and we will enter into contracts with beneficiaries such as the Forest Service, such as water utilities, electric utilities, et cetera. And that's the cash flow that will come in to pay off the investors in the bonds. And so I think this is a type of thing that we've been working on it for about 18 months now, and we're just going to market with it, and we think it's going to be something that can be cause very much a change in the financing model for not only, you know, things that are similar to the forestry resilience bond, but for other climate change types of issues that have not been able to get private financing in the market.
Yeah, thanks. I think, you know, the next topic is we got a lot of good investment ideas, but we got to bring the asset owners to the table. And I know from some experience that it's not so easy. And Joseph and JoAnn have some experience bringing the horse to water and getting it to drink. So maybe you can talk about some of the challenges that you've had and how you view the opportunity and how you've been persuasive.
How much time do we have left? Just in terms of getting people, when he means talking about the IC, the investment committee, getting folks to think in a different fashion. I'll give you just an example because it happened recently. We heard from a group of people, we have what we call the General Assembly for the Presbyterian Church every 2 years, so 2016. We heard from people who were quite upset and wanted to talk about fossil-free and all that and get us out of certain companies. Make a long story short, we had to get people set to do something entirely different. Presbyterians usually have a meeting to determine they're going to have a meeting to have a meeting. Okay?
So like most investment committees.
Right. So we had this discussion, and from the time that we had the discussion, this is again 2016, to the time we put $100 million in a fund on March 1st, was roughly around 7 months, I would say, maybe a little longer than that. For Presbyterians to move that fast is lightning speed, okay? That's not what we do. we deliberate. And on the investment committee, and I also chair the Environmental and Climate Change Committee for the church. So I was wearing 2, if not 3 hats in having these discussions and getting people to come to a certain, as I would say, our stated clerk, the head of the church, the Reverend Dr. J. Herbert Nelson said, we need to get off our blessed assurances. So we had to move and do something in community. It required understanding what is a principal thing for us, care for creation. It's the environment itself, okay? If we believe what we say we believe, then we care for this creation. We are responsible for being a prophetic voice and doing something. But nobody cares about being a prophetic voice if you don't have profit, okay? So we had to figure a way to put some money aside, invest in this particular fund, and give people the choice of having a relative fossil-free investment vehicle. So that, again, we could be responsive, but we also were being responsible to our pensioners. Because the idea is to do what? Make money. And grandma doesn't care if you are doing all these wonderful things and she doesn't get her pension check.
Yep.
We have responsibility to our pensioners to do that, and a fiduciary responsibility.
JoAnn, you have to work with investment committees. What are some of your tricks?
So we're aggregating Episcopal endowments, and so I work with investment committees from our largest is in sort of the 30 million mark range to our smallest is around $1 million. So you've got a range of different folks and perspective. And the 2 big obstacles are performance. You know, if I do this, will I not deliver the money we need for our mission, and fees. And I'm going to put the fees aside for later in the conversation. So on the performance side, we have a basic investment philosophy, which is valuation oriented, and that's the framework. But then as ethical investing has moved out of primarily screening and into ESG, there really are a lot of studies that show you can get comparable performance. And so there was a Deutsche Bank meta-study of studies indicating this. Harvard Business School did a study in 2015, and University of Oxford, which shows that corporations which engage in conscious policies about the environment and social and governance savvy, those folks have better profits and lower cost of capital. And so it is an educational process to say to folks, you know, here you can get comparable performance. So MSCI's ESG index performs at the same or slightly above their regular all-world index. The other thing that we've been able to emphasize a lot is risk avoidance. So we weren't, for example, in Equifax. MSCI downgraded Equifax in August of 2016 because of privacy and governance considerations that kicked them out of our portfolio. Volkswagen, bad governance. And very often I find that investment committees relate more towards thinking about risk avoidance. You know, that gets their attention.
Do they think about climate risk yet?
No, I don't think they do. I think that sense of stranded assets and climate risk is more down the road, that the motivating factor is from an impact on their portfolio. I think that the folks are more motivated by, we need to address climate risk. This is a moral imperative for us as churches. But I don't think that sense that they're going to, their portfolios are going to be damaged by continuing to remain in energy is the driving force.
So I think it's interesting. Impax has done a lot of work on thinking about climate risk, and the way we think about climate risk is, you know, climate change, it's a pretty far off thing. Discounted present values, it's not all that material today. What is material is what a government's going to do about it. And if you think about the government response to it, our present government aside, it's going to be around trying to reduce carbon emissions. What does that affect? It's carbon emitters and carbon producers. So that leads to this fossil fuel divestment. you're not good at market timing, maybe you should just be out of it. But then you've got, you're getting rid of some energy exposure, replacing with different energy exposure. Rob, how do you think about replacing that energy exposure with something, we'll call it good energy?
Good energy, I like that. I want to touch on your last point, though, because I've seen it myself in conversations with large fiduciaries, the sense of climate-rich and stranded assets is sort of left there. But actually, it's Moody's. The recent move by them to announce that they're going to start assessing city-level bonds around climate risk. That's a sign of the kind of sea change where this could all happen a lot faster than we think, right? When that thinking gets out there. But to your specific question, it's interesting. Through CREO, the collaborative family office platform that I described, it brought us in contact with a lot of other non-traditional or at least larger type investors. I was invited a couple of months ago to the UK to an invite-only meeting of a bunch of fiduciaries over there. Not at all climate or environment focused, but instead it was really just how can they figure out how to collaborate with each other more. And what was really interesting to me was hearing all of them, even without an environmental context, keep repeatedly bringing up, okay, but how can we invest in emerging market solar? How can we figure that out? Because that's going to be really big. It's just another indication to me, number one, that there really is a lot of latent demand out there among the larger corpus of investment dollars for this kind of solution and really leapfrogging the prior fossil fuel dynamic. But it also struck me just how frustrated they all sounded. Because I can tell you from my vantage point that a lot of my peers, it's not what we do, but I have a lot of peers who are eagerly trying to introduce new models for investing into emerging market solar. And, I would argue that on the large format side of clean power generation, a lot of that's been figured out. As Torsten was describing, there's a recipe for how you do the development. I mean, it looks like classic power project development now. And has been, I would say mainstreamed to the point where the capital is available to it, to the point where green power project finance actually has lower yields than traditional fossil fuel project finance. And that's not because the projects are doing more poorly, it's because more people want to throw money into those, right? But meanwhile, a lot of the solutions for especially emerging markets, but even here in the US and North America where we focus, a lot of the really intriguing new solutions for clean energy, behind the meter microgrids based on solar, things like that. These do not have the established investment models because they are smaller scale than traditional project finance can do. And that's again where there's just a real challenge for the institutional investor community in trying to figure out, okay, but how can we get into that? How can we be released into the same kind of thing that drove in the more simpler version of that rooftop solar to be such a huge booming market, and certainly in the large format power infrastructure to be somewhat figured out. The types of investors that I have seen now that are stuck because at some level, whether it's the investment committee or the board or constituents or various stakeholders that are now pushing them to go fossil free in their investment approach. And then they're presented with this efficient portfolio problem where I've had CIOs say, I can't give them what they want because I just don't have the place to then park the money. You've got to take the money off the table from somewhere. Where do I park the money where it's equivalent in terms of its risk-reward profile and where it fits into an intelligent portfolio allocation theory? Again, that speaks to me as to where exactly people are wrestling with this right now, because it's not a lack of capital that wants to be put to work. It's a lack of capital that has been shown highly replicable, reliable ways of being put to work in exactly the format they need to see. The nice thing is, like I said, I see a lot of my peers, certainly our group, introducing these new models to the marketplace to try to unlock all of that. But I view my job as, getting to a point where we can go to those fiduciaries that were in that room and have them say, oh, it's just like that. Right, that's how it happened. Like I said before, this black box, turn the crank, it makes money, good.
Right. We just need lots of more of those examples. Kareen, maybe you've got some thoughts on how to think
do.
about this from the public side.
Yeah, I mean, look, our portfolios are not divestment vehicles, although we recognize the need for the asset owner who are facing pressure from their constituents or from their boards to create fossil-free portfolios. The very nature of what we do and what we look for in companies allows our portfolios to be fossil-free. So that's just an output of the process. It's not how we got to this point. Where we're finding opportunities for returns happen to be in companies that are not emitters. So we're commercial, right? We're in this for profit. And so in order to kind of help the conversation with committees, we do footprint our portfolios. It's not how we start, it's not how we screen, but we do want to show, potential investors that, and we're using True Cost. We decided True Cost was a good provider for it, which is now part of S&P, as you know, to just footprint our portfolios as standalone, and then also versus the respective indices that we've decided to benchmark ourselves to. That's a whole other conversation, not for today, but benchmarking is tough because you all need to benchmark, and we look nothing like the EM benchmark. We're also in Frontier, which is a flawed benchmark, and we're benchmarked to the world in our Sustainable Growth Fund. And by the way, most of the companies in that portfolio are mid-cap names, undercovered, under-researched. We look nothing like the world. So there's a ton of tracking error, and it's good tracking error, and it's a lot of active share, but it is a very tough conversation to have in a world where there's quite a bit of sort of buckets and box checking. So we do check the box on fossil free. So coming back to climate and considerations around climate, when we're looking at companies, and I speak a little bit more from sort of the developed equity portfolio, again, we're looking for business models that do contemplate climate change and climate risk in the way they're operating, or again, as I said, transforming their business models for a world where we are going to have water scarcity or we need renewable energy. But we also operate in a valuation framework too, and we will not pay up for that growth. So, we do look at renewables, we look at solar, we look at wind, but rather than buy the outright providers because they're too rich for our portfolio right now, we own the company that makes the ball bearings inside the turbine, and that nobody knows about. So that's our approach to sort of renewables, is to kind of really go a little bit off-piste and kind of find some idiosyncratic, misunderstood stories where there could be value creation over time, and get there early and look for disruptors and look for new technologies, but to be there and hopefully watch sort of that value creation and the stock re-rate as the world recognizes that there's growth there. And it's similar approach, and this is why we love having these two funds sort of side by side now, because the Emerging Markets Fund is a new entrant to our platform, is we think about the world that way as well. The growth drivers within emerging markets, the dynamics are different. Climate change is very real. You have these large populations taxing, and we've also been asked by investors to the stranded assets question, well, you're in the, if you're fossil free, but you're in these countries and these are big commodity producers, some of the countries are commodity importers, do you run the risk of falling behind, when energy prices come up like they have recently? And the reality is, and we've kind of back-tested the EM portfolio, many of the countries we have exposure in are very correlated to the price of overall commodities. But what happens is when in either direction, you still get the exposure by having country level exposure. So you get it from the macro, but you don't have to have it at the micro. You don't have to have it at the company level. We can own very good companies with corporate governance that are non-emitters and really create a fossil-free portfolio to meet the needs of the institutional investor, but still participate in the growth drivers at the country level. But we don't fall behind when the correlation between commodity prices goes out of whack, because the countries themselves, it's a bit of a tailwind effect. So we learned that now kind of 3 years in, because we lived through the cycle in 15 and we've seen what's happened this year. And even though we want to be green and do good and contemplate climate, we also recognize that the markets operate in a certain way as well.
Yeah, so JoAnn and Joseph, I was wanting to get to, again, we got to bring these decisions to asset owners. Asset owners got to buy in. There's tracking error that Kareen was talking about. There's country focuses that are a little different, areas of interest that are different, vehicles probably a little bit different. How do asset owners get over these hurdles and start deploying capital to address climate risk?
So I'd like to expand on my answer where I address stranded assets as a motivator, which misses the big picture, which is obviously climate is very important in the decisions we're making because that's why we're doing ESG. It's if you, particularly in the current environment that we're in where alas, U.S. government policy is not supporting addressing this issue, it then becomes what is the corporate world, what is the real world out there doing? And so we're looking for companies that are conscious of this, who are thinking about this, who are addressing these issues to affect climate change from the ground up by the companies that we choose to support. So the way we've implemented has been, I mentioned cost, and one of the challenges has been that some ESG solutions are moderately expensive to invest in, and so we started with doing essentially a MSCI ESG screened and factor index, medium and large cap stocks, and international developed, and that enabled us to put our foot into this type of investing at a very low cost, which made our committee comfortable. The next move was to go to emerging markets, ESG screened. We are doing separate accounts in bonds where ESG is taken into consideration. So when the dust settles, if you look at, and this is where the putting it all together gets tricky, because you have self-identified managers who are ESG, and then we have a whole lot of managers who are PRI signatories. And how does that meld, because they're not labeling themselves the same way. But our portfolios range from about 50%, what we would consider the combination of those two, up to 80%. So we are looking to integrate it because we feel that climate has to be addressed from a grounds-up perspective if we're not getting as much governmental response in terms of approaching it.
So it sounds like it's incremental. Joseph, was your experience different?
Yes. A little bit. I just want to make sure we understand something. Again, for us, it's about make sure we have the returns because they have to be there. We are 125% funded. We're 300 years old. We started out as something called the Fund for Pious Uses. So we have to be very careful about what we do. And right now, we're about 13.4% up this year. In order to maintain that, we have to make sure that we're investing in companies that have what as a key trend? Growth. They also have to have management capabilities. One of the things we found in our research, thanks to some people from Oakham and some other places, I hate to do a commercial, I'm sorry. But one of the things we found is that if management is doing well on sustainability, they're also outperforming in other areas. And what does that give us? That gives us the management trend, which says that we're investing in management capability. And that means we have a return on that investment. We ask our managers, and Ariane heard me say this before, we don't fire anybody. We're church people. We excuse you. Okay. So if you are one of our managers and you are not performing and doing the things that we ask you to do, we excuse you. And what we're involved in right now is making sure that, yes, we have the fossil-free indices for us. We have research on that. We know we're doing the right kinds of things. But the basic thing is to have the return. We have to have it. That's our fiduciary responsibility. We like to say that we are at the nexus of value and values. That's important. But it's about making the money, too. Okay? Christ paid taxes. Think about it. Jesus Christ paid taxes. Remember he got the thing out of the fish? Just gave it away to somebody? Said, okay, go pay the taxes with this. What are we going to pay our taxes with? What are we going to pay our pensioners with if we don't have the return?
Any additional thoughts on that, Torsten?
I don't think I can top that. The one thing I found interesting, what Rob was saying earlier about the
the capital that's saying, how am I going to invest in this, right? And I think it's not only into these smaller solar initiatives, that sort of thing. I think it's not only foreign, but also the United States. And we're seeing right now where with the rooftop solar was able to be done because the spreading of risk amongst so many houses, right? Yes. And you're able to set up a financing vehicle for that. We're having difficulty right now in community-based solar initiatives, which are small groups of people trying to set kind of a cooperative of doing solar. And the biggest problem that investors are having is the risk. It's the offtake risk, right? What happens if one of those small entities, which is a much larger proportion of the whole, goes under? So I think that is a big, big challenge that we're going to get through.
Totally agree. Funnily enough, in our previous incarnation, we invested in one of those platforms. And I think part of the answer here is doing exactly what you described happened in rooftop solar, the structured finance pooled asset approach. You can do that even across slightly larger scale projects, certainly community scale solar as well. And certainly when you look at things like, corporate level behind the meter microgrids, even municipal level, those are smaller scale projects than traditional project finance. I mean, traditional project finance, let's be clear, is let's build an airport. Right? It's multiple years, it only pencils out with all of the overhead of what you have to do if it is a very substantial project. When we were at a single family office and we were trying to figure out how to invest into project finance, because like I said, we were experimenting, trying different things, we didn't have enough capital to be able to tap into that world. Right? And it was a severe frustration for us. What we did find was that being able to invest into these, and really pioneering these kind of structured finance solutions for some of these types of not just, solar, but really looking broadly across all of these industrial size, meaning smaller than, utility scale, things across the food, water, energy, waste landscape. That is a huge unmet need. And when you look at Ceres, right? Ceres has identified we're going to need to roll out $1 trillion per year to meet our climate needs. What is that trillion going to look like, right? Well, a large portion of it's going to be large format infrastructure. But a huge portion of that is going to be not large format infrastructure, and only a very, very small portion of that is going to be what gets all of the attention in terms of corporate investing, in terms of like startups and helping the next great startup get off the ground. I couldn't agree more that what we need to do is find the ways to take that capital and find it a good home behind really strong growth. And I think what we're going to find is we need, like I said from the beginning, we need to build out more of this sense of a capital ecosystem so that what we're able to do is not just find a home for the capital where it fits into anybody's efficient, portfolio asset allocation, but what we're also going to find is when development platforms, especially around smaller scale assets, get access to the right kind of capital instead of jamming existing asset categories in there somehow just to be able to roll these assets out, we're going to find that spurs tremendous accelerated growth too, because that's exactly what happened in rooftop solar. Yeah. A new model was applied. It frankly wasn't even a new model, just new to that market, and then it spurred that growth. One thing I do want to say real quick, because I think it will be helpful. A lot of the people in this room who are impact investors are going to be wrestling with this, and Confluence Philanthropies, shameless plug, I was a co-author on it, but Confluence Philanthropies just released a white paper with a lot of useful questions. So if anybody wants a copy of that, just let me know. Be happy to get it to folks. It's just a lot of good questions to be able to ask internally with everybody from your programmatic team to your endowment team, your investment team, just to make sure you're seeing what you need to see to be able to make these kind of decisions we're talking about.
And speaking of asking questions, I want to leave some time for the audience to ask a couple questions. We've got 5 minutes or so. We've got some practitioners who might have some good ideas. Please, in the back.
It's a $100 million investment per sovereign, potentially, but it's ultimately not dissimilar to a public-private partnership, but it's tech. It's a platform. So the problem is everybody in the middle classes. So in the end, it's a shared capitalist responsibility kind of model. Where we're taking stuff from the telco industry, we're taking stuff from here, and we're asking industry to back up and give us 3 to 5% in $250 billion market. And we would take those funds and give it back to the public good, which means we have less high needs. And through education and equipment, that kind of thing. So I find explaining this to parties, the capacity issues are still a factor. So in PPP, they don't really have strong tech. And ultimately, the platform for business owner is exactly the infrastructure platform. It's an operating service company, it's an asset management grant company, it works with the states,
Is there a question in here?
So the point is, where do we go?
Where do we go?
Are you going to repeat the entire question?
Yeah, you've got to repeat the entire question, remember?
Right.
Did you have the mic?
So vehicles are a challenge, and taking a business model that works in one area of the economy and applying it to different areas of the economy is
Because of
definitely
the
a
way
challenge.
everybody's structured in the asset classes, understanding, so impact investing, more debt-based, would be helpful.
I think, yeah, perhaps. Well, we've got green bonds and things, and then Kareen and I would both say there's lots of opportunity in listed equity to have a positive impact, and clearly our investors over there believe the same. Don't know that we have any good short answers. Maybe you could follow up.
Just a quick amen on what you're saying, though, and it's important, again, for folks in the room who want to play this catalytic role to help new models get started to know this. Right, and so one of the challenges that I see a lot of the GPs trying to launch new models face is that they walk into a potential LP, and because it's a new model, it straddles different asset buckets. They get shunted to a completely different team at one group versus another group. Sometimes it's real assets, sometimes it's project finance, sometimes it's growth, sometimes it's just private equity, lowercase p, lowercase e.
Classifying this stuff gets
So if
challenging.
you have an investment platform where you have the flexibility to have cross-cutting conversations within your team, recognize that as being really potentially powerful.
One more question, please?
So more just a comment on Catherine Gottschalk with Calvert Impact Capital, and we haven't talked very much, Rob, you mentioned sort of the capital continuum, and we talked primarily in kind of asset classes, public and private equity. But I just wanted to throw out there, the comment about how do we get into some of this, solar technology, energy access internationally, private debt blended finance structures are emerging in that specific place. So I just kind of want to throw out there that I think that's a very vibrant area and an asset class for even institutional. Some of the newer funds are at the scale where even institutional investors, but certainly smaller scale impact investors can kind of look at it and see opportunity.
Great, thanks. One more question? Please.
More formally from Deutsche Bank. I have a question. We're talking about climate change, and we get a lot of inquiries from companies that are setting up grant plus funds. And I just I'd love to hear your opinion about sort of the benefit of those funds and what if you see that there's opportunity there.
So sorry, the red plus?
Yes, REDD.
I'm actually not familiar with that. I mean, maybe you could just maybe I don't know it by the terminology, but is that just a sort of a restrictive portfolio or?
No, it's a normally they're used when people are trying to put together a sort of a forestry structure, and they're trying to capitalize on the external benefits of that type of investment, as well as
Monetizing the impact or something?
yes, exactly.
Understood.
It's fairly similar to what I was talking about earlier, what we're doing with Blue Forest Conservation. And, but I guess it's a question of, because what we're trying to do is monetize the impacts, the positive impacts, both the revenue enhancement plus the loss avoidance, right? And I've not heard of these particular instruments, but it sounds very similar, because what we're trying to do is put together a public-private partnership of everyone that's involved in the process, right? There's a lot of different beneficiaries. There's a lot of need for it. to deal with deforestation issues. And there's a lot of, mine is concentrated mainly on the health of forest in watersheds, right? And it has to do with, water quality, air quality, recreation quality, and also other related job creation, all those sorts of things within that particular area. I think that what you're talking about may be what I've heard a little bit about of dealing with deforestation on mass scales in certain areas of the world, in the rainforests, particularly in Brazil, particularly in areas like Indonesia and Asia. So I think it's exactly the thing. We're trying to get these financing models that we've used elsewhere to use them within this field so that we can, if we can create enough beneficiaries that are able to pay for the investment, that's exactly, I think, what we're all trying to do at this point.
I know we're tight on time. Just to add, now that I have a better understanding of what you're talking about, one of the reasons we formed our Emerging and Frontier Markets Fund at a previous firm, which was a specialist EM manager, was that our chairman is also the chairman of the World Resources Institute. So since this panel is on climate, if you're not, and the little plug for WRI, if you're not familiar with WRI, I encourage you to look them up. They have done a lot of work in this space. They have an initiative called Forest Watch, and one of the missions of WRI, even though they've been, they think about the world sort of in buckets, forest, water, climate, cities, sustainable cities and initiatives, was to also think about finance and the intersection of finance and climate through an initiative. So they're trying to partner with asset owners and asset managers to convene and create, because they're very good at convening, but they also have tremendous amounts of data. And in this forest space, as well as the water space, they have a data that's now going into the Bloomberg. So just to talk about what this means for asset managers looking at risk factors related to climate, it should become part of the way you do investments, right? You need to contemplate these factors. I know it has nothing to do with these fund structures, but I am saying there is a lot of information out there about forestation and deforestation.
It's a great segue to the last question I wanted to ask. It's kind of a lightning round, which is the WRI has said that we've got 2 years to address climate change. Otherwise, it's really difficult to address it. Got to cap carbon by then. So how do we take addressing climate risk and get it to be, now, and not something that's, it's in the future? And that changes thinking, but how soon before this is just part of how we do business, how we invest, and the catalyst for that? Quickly going down. Rob?
I apologize to everybody that I keep going first. And funnily enough, I used to work at WRI. That's actually where I started out my career, and it actually launched me on all of this. And so, yeah, exactly. And that was my job 20 plus years now ago, was working with large companies, helping figure out how they could integrate these things into their just normal course of business, and stretching that then into the investor sphere as well. How long until it becomes completely mainstream? Unfortunately, I don't think it happens overnight. I do think that things like, having the rating agencies start to, really incorporate this and having the data available so that it's on Bloomberg terminals and all of this, starts to reach tipping points where it is mainstreamed. But honestly, I'm just a big believer. I've become a big believer over the years that if you want people to do a whole lot of something, you just simply show them that it's really easy to make money off of it. Yeah. And that's what we need to do, is establish that. And how long that's going to take? Longer than 2 years.
Kareen?
Well, I echo what Rob said about returns. I think you've heard me pound the table on returns, which is what the asset owners need. But I think it happens with the tipping point of the deployment of capital. I think capital from the asset owners and capital into the space and into these companies is really where the power lies, right? So you have to have sort of the inflection point of more capital being deployed into strategies like ours and others like ours in the industry, to validate both the asset class. And frankly, for me, and we work at differentiated firms right now because we're in the minority, but what happens is everything is going to be ESG. The whole reason I've been sort of parlaying in this space, it has to be ESG. Europe is way ahead of the US in this regard. All the Nordic sovereign funds have been doing this for a while. Ironically, if you think of the source of their wealth being from energy, the fact that they've been the early divestors is saying a lot, and they represent trillions and trillions of dollars. And so I think it's about the nexus of capital deployment, but it's also about realizing that this is the right way to invest to to deliver returns. We have to. We don't have a choice. So 2 years, I don't know, but the more that we can continue these conversations and mainstream this, it may put firms like ours out of business because the big guys get in the game. But I mean, at least we're sort of validating the asset class by building reputable track records and sort of sticking to our knitting and showing that you can do this. And so, it's a bit of a David Goliath at this point, but I think, if our firms get put out of business because everybody's doing it, that's a good thing in the end, right? That's
Torsten?
the way I think about it.
Yeah, and I think on top of that, it's also very important not to forget the public part of it, the governments. Because if you don't have buy-in by state, local, and national governments, and internationally as well, it's just not going to happen. And this can come from the strangest places, and I will say very briefly that the state of Texas, wind power in the state of Texas just surpassed coal-based power generation in Texas. Give that a thought, Texas, okay?
They're a bunch of hippies.
Joseph?
Very quickly, for us, it's telling the managers, this is what we want.
Right.
End of discussion. And we want you to do what's called the 2-degree scenario analysis. If you don't have that, we're not going to be putting money into you. It changes somebody's thought process, let's put it that way.
Amen.
And that's what we have to do.
And the second part of the mission that I talked about that CIG has is the educational side of it. And I wish that most investment committees would come at it from that perspective, but that has not been my experience. And so it is explaining to people that if you pursue this path, which has benefits to the environment, which has benefits to workers' environments, you're not leaving any money on the table. And that really is education and experience. When we invest and we see that we are making the returns that we anticipated or better, that encourages people to move forward.
Great. Well, thank you all for joining us, and join me in thanking our panel.